Right, so today we're just going to be running through understanding the 18-year property cycle. So, and why? Because once you understand the property cycle, you'll know that there's reason why property prices are always going up in the long run. It'll give you more confidence that they'll continue to do so. They won't go up in a nice, smooth, straight line. As we know, there'll be crashes along the way that are inevitable, and because this is just really just the way the system's set up. And that you can ignore, which I'm sure you've heard us bang on many times. You can ignore what the newspapers say about property prices and have a far better understanding of what's likely to happen by looking for certain signals, sort of in the world and the economics around you. So, why is there a housing market cycle? What it comes down to is forces of supply and demand, and keeping that pretty much keeps everything roughly in balance. So whether it's goods like cars or labor like things such as barbers, the forces of supply and demand will keep prices roughly in balance. And for example, if everyone starts deciding today, right, let's all go and get our hair cut, it'll be impossible to get an appointment, and barbers will just raise the prices to make a profit. So soon the higher prices attract like new barbers to the market, for example, and the extra supply, I mean that everyone's going to reduce the prices to remain competitive. But it's a little bit different in the land market, though. This can't happen in the same way because the amount of land in existence is fixed. We can't just sort of magic up any more new land as extra demand goes up. So what this means, it doesn't take people long really to understand what's happening, and that they'll get a best return on the money if they start to look at property. And at times of particular high demand, people will speculate and start buying property on the assumption the price will continue to go up. And because of this, property prices increase faster than wages do. The property eventually becomes unaffordable, and the majority of people, for the majority of people, and when this happens, that's inevitably that's when the base comes. So property prices start to plummet, causing chaos in the banks, which are being lender money secured against sort of high price property. The banks they'll begin to withdraw the lending. The activity slows down, and businesses start to shut down, which all has knock-on effects, and even on the likes of the stock markets and employment levels. And eventually, of course, prices drop to a more sustainable level, and everything gradually goes back to normal. And at which point the whole cycle that we're looking at just starts again. So there's various different stages of the 18-year property cycle, what we'll take a look at. So the length of a full cycle on averages out around 18 years, which each cycle divides into distinct stages. So you've got year 1 to 7, 7 to 14, and 14 to 18. So we take a look at the first stages of the cycle. You see, it's divided sort of from one stage to the next, but we'll start at the recovery phase. So at this point, prices have bottomed out, the end of a recession, the recovery phase is just beginning to get underway. Prices have fallen far enough to tempt investors back into the market, attracted by high yields that offer a result. But rents pretty much stay the same. Rents don't really fall because everyone still needs somewhere to live. And even if renters are brave enough to take advantage of the lower prices and buy, this is the toughest point in the cycle at which to get a mortgage because banks are also struggling too. And the sort of the more brave investors are investors who've spotted opportunity to get it at rock bottom and willing to take the risk on the asset, while the confidence is low and investment case is still sort of unproven. But no one knows precisely at what point this is actually going to bottom out. Smart investors are just taking an educated guess really around the knowledge that the upside potential is greater than the downside risk. But at this stage, a lot of the amateur investors, they're totally absent from the market. And with the lower prices and the lack of competition with lending, this is really the best time to be buying in the recovery phase. So as the recovery phase starts to develop, more buyers will have confidence to enter the market. This has the exact effect of pushing prices gradually upwards. And at this point, you can look out for big companies starting to buy up distressed portfolios. They'll have market intelligence that's to get in early, but not really to take a risk to get in too early. So it's a good signal of recovery. And this is, like we've said a few times before, it's sort of following the big boys. They've got the intelligence, they've got the funding to invest in that intelligence. So if you start seeing them to do more activity, it's an early sign for you. And also the prime assets, which are always sort of the most attractive. the early growth tends to be in the city centres, and it'll ripple out from there because that's where the prime assets are, right in the centre. And then what we do start to see is a mid-cycle dip at this stage. So it's what it is, the early movers that got in early at the recovery phase, they want to take their profits. So they've looked at it, they don't want to carry on, and they're a little bit hesitant, so they'll take the profits early, and that's it really. That's where you see that mid-cycle dip. But that is also a sign that the explosive phase is on its way, and it's more clear now. Prices are on the up. The banks will be over the shock of the recovery phase, and they're willing to start lending again. Suppliers have got enough confidence that capital and major build projects start again. Like we said, then you'll start to see more cranes, more skylines being built. House prices will start to increase faster than wages. And at this point, like we just mentioned, then it's when the media gets interested. And as you can guess, as soon as they get interested, you'll probably start to see big headlines. And what this fuels is people start to speculate, okay, I want to move up the ladder. I want somewhere bigger before it gets out of reach. They start to increase the mortgages. A lot of the time, they start to over leverage, start looking at holidays, cars, which is not advised. And the banks make it easy for them to do so. And so everything's in full swing. They can lend as much as they possibly can. And at this point, the logic, everything goes out the window and the psychology kicks in. The higher the prices go, the more everyone assumes that they're just going to keep going and going and going. The thing is, when we're buying at this level, it's just pushing prices up further and further. And we've seen an example of this through COVID with pent-up demand when the market just went crazy. So the investors who got in early, they'll quietly sort of be selling off what they can really to lock in their profits. As we move towards the peak of the explosive phase, it's then a seller's market, and you'll see estate agents they don't say a guide price or offers over. It'll just be a locked in price. They'll have open houses, they'll have block viewings, and people will just you can just see they'll just start to seal bids on things that give it a couple of years ago they were just not getting nowhere near. And you can start to see the properties are selling well above the asking price. You start to see developers also, they'll start to come in and they'll be marketing even more off-plan properties just to capitalize on what we're seeing at the moment. And then also banks will start to loosen their lending criteria because they just want to grab a bit of the action as well. So looking at point 4, we're well and truly into the explosive phase now. So the final couple of years of explosive phase, prices have reached the peak, and it's monitored closely because everyone sort of knows what's around the corner, which is the recession. And it won't be long before the asset that you did buy in the explosive phase, that'll be worth a lot less. So none of us really know the exact when the final years are going to be. We just know that there's going to be, it's already happened, and hopefully it's not too late. But there's no shortage of warning signs at this phase, because even though we're at the top, you'll start to see projects that are just crazy. You see overblown building projects. So you'll start to see things in the media like the world's tallest building or biggest shopping centre. And this is where people have just got a bit carried away in the explosive phase, and they're just over ambitious on their ideas. And often what you'll find is we're already past it, and these buildings you'll start to see are unfinished. And that's where we know we're starting to approach the final sort of recession phase then. And because through all this, the market was being driven by fundamentals, it's easy for the confidence to suddenly just evaporate and take the whole market with it. So prices, you'll start to see plummet. People are over leveraged, start to go bankrupt. You'll see people they're forced in a way to sell the properties, pushing prices down even further. And it's impossible to pinpoint exactly when it's going to happen, but you won't need to be told. You'll just see the newspapers. They'll just put it right out there. They like a good bit of bad news that always sells the news for them. And you'll see the panic, your horror stories. Recession phase seems like it's going to last forever, and you're well and truly into recession. But again, it doesn't stay forever. Again, eventually it'll just do a full swing and all start again on the 18-year cycle. And we're in this phase right now. It's a little bit unusual because of COVID with pent-up demand and certain economics that are a little bit unusual that have happened in this cycle. It just feels like it's being pushed a little bit closer. So we did have an explosive phase through COVID, and now we're starting to see that recession phase, and you'll probably see it all over workplace that now is sort of a good time to be buying, and we can move on to that next really, so you can see how we can profit from the property cycles. And like I mentioned, then actually, like perfectly on this one, it's COVID 2020. So how can we profit? I mean, the predictions that prices were going to fall around 10 to 15%. Instead, prices end up actually rising by 20% over the following 2 years. So like I mentioned, it's a tricky one because there was economic impact that looked a lot more serious. It was a little more closer than what the cycles are predicting, but still guided by the cycle prices, it was saying that things were going to rise. So if you followed that, you could see that where everyone's saying things are going to crash, going to be 10, 15%. If you followed the cycles, you could see that was actually due to start to rise. So, and again, what we said here, remember each cycle starts at a higher level than the previous one. So when you can see that buy, say time is always on your side, it is. If you buy and hold for 20 years, it's still going to be a valid strategy. Because if you sit around waiting for prices to fall, you can just be missing out on a lot of income. And you'll hear people saying the best time to buy is always yesterday. Because the thing with property and asset-backed investment, it's just going to go right back hundreds of years. It's always going to slow. There'll be ups and downs, but it's always going to slowly increase as it starts the cycle. It's always a little bit higher than the previous one. So I think what will be good to put out on here is just sort of the basic rules of the 18-year cycle. So first, we've got don't panic and sell a property just because prices are falling. Thanks to the cycle, the prices, they won't go to zero, and it won't be that long in the great scheme of things until we're back beyond that. It's done that full cycle. So you don't want to start panicking and just offloading everything just because things are falling. Again, with time on your side, they will start to go back up. And don't put yourself in a position where you're forced to sell at the wrong point in the cycle. And this means not over leveraging at the peak and making sure that your portfolio can withstand temporary falls. So what a lot of people do, they'll buy in that explosive phase right at the end, and it's just not a good time to be buying. It's more of a seller's market. So if you buy at that point and then it dips, you've just over leveraged yourself, and at that point you could be forced to sell at the recovery phase, which you're going to be getting rock bottom. Then you want to be selling at the explosive phase. So just make sure that you stress test everything when you're looking at your offers and when you're purchasing your property. And don't get carried away. I mentioned it there. Don't get carried away when your prices are too high and lending's cheap. This is possibly the worst time to buy, and prices will soon fall, and they won't recover until relatively later on in the cycle, or even worse, remortgage for liabilities, which a lot of people do in the explosive phase. So point forward, don't get misled by the media. As we've already seen, the messages they pump out around turning points in the cycle they can almost be the opposite of what the investors and what professional investors are doing. So putting the blinkers on, shutting it all out, it's easier said than done, but it's vital for making the right decision. And be a seller when everyone else is buying. The peak phase is a terrible time to buy, but a great time to sell. And if you don't have to sell everything, but it's a perfect opportunity. If you've got a property that's not really performing too well, if you can sell it, then it's a good time just to release that asset while the explosive phase is around. And then be a buyer when everyone else is selling. It doesn't even have to be at rock bottom. A lot of people's memories, sort of the crash lasts a lot longer than the reality. So the estate agents' offices normally they're pretty empty even after prices have stabilized and they're creeping up again. They're still fairly empty. So it's a good time to be a buyer when everyone else is selling, which is at the point right now, really, when we look at the economy around us. And then stockpile your cash during the peak phase. So once we're in peak, you want to be prepared for the recovery stage. So mortgage lending will automatically sort of become tightened when prices take a tumble. So even if you're ready to buy now, you're going to then struggle for the lending. So if you can sell while you're at peak, it just gives you a nice capital pot to deploy when you're in the recovery stage, when people are struggling with the lending. Yeah, and instead you're just trying to raise funds in advance by selling poorly performing properties or refinancing to sensible levels while the properties are in that explosive phase.